You've heard this your whole life. Stop buying coffee, cancel your subscriptions, skip the avocado toast. If you just stopped wasting money on small things, you'd be rich by now. That advice has been repeated so many times that most Americans actually believe it. They feel guilty about a $6 coffee. They stress about a $15 streaming service. Meanwhile, the actual reasons they can't save money, the real ones, the ones that are costing them tens of thousands of dollars every single year, go completely unexamined. Today we're talking about those reasons, not the lattes, not the subscriptions, the actual structural forces that are draining American paychecks in 2026, and why the personal finance industry almost never talks about them. Because here's the uncomfortable truth. Telling you to cut your coffee is very good for business. Telling you what's actually happening to your money? Not so much. Let's get into it. First, let's actually do the math on the latte thing. Because numbers don't lie, even when advice does. A $6 coffee every single workday. That's $6 times 250 working days a year. $1,500 a year. If you invested that $1,500 every year for 30 years at 10% returns, you'd have about $247,000 at retirement. That sounds like a lot. And sure, $247,000 isn't nothing, but here's what nobody tells you. The median American household income is around $74,000 a year. After federal taxes, state taxes, Social Security and Medicare contributions, take-home pay is roughly $57,000 a year, about $4,750 a month. And the median American household spends approximately $4,500 a month on necessities alone. Housing, food, transportation, healthcare, utilities. That leaves $250 a month in breathing room for everything else. Clothing, emergencies, gifts, entertainment, savings. $250 a month. That is not a latte problem. That is a structural problem. You could give up every coffee, every streaming service, every restaurant meal, and you still wouldn't have enough left over to meaningfully change your financial future. So let's talk about what's actually eating your paycheck. Savings killer number 1, housing. The standard financial advice says, spend no more than 30% of your gross income on housing. That's been the rule of thumb for decades. Here's the problem. That rule was created in 1969. The American housing market in 2026 looks nothing like 1969. In 1970, the median home price was about $17,000. The median household income was about $9,800. The ratio of the home price to income was roughly 1.7 to 1. In 2026, the median home price is around $420,000. The median household income is $74,000. That ratio is now nearly 5.7 to 1. Housing has become more than 3 times more expensive relative to income than it was 2 generations ago. What does this mean in practice? It means that in most major American cities, a household earning $74,000 cannot afford the median home. Not because they're spending money on lattes, because the math simply doesn't work. Even renting has become devastating. The average 1-bedroom apartment in America now costs over $1,500 a month. In coastal cities, New York, LA, San Francisco, Seattle, Boston, you're looking at $2,500 to $4,000 for a basic apartment. If you're spending $2,500 a month on rent on a $74,000 salary, that's 40% of your gross income. Gone. Before taxes, before food, before anything. You cannot save money from what you don't have left. The housing cost crisis is the single biggest reason American savings rates have collapsed over the last 30 years. Not avocado toast, not Netflix, housing. And cutting a $6 coffee isn't going to fix a $1,200 monthly gap between what housing costs and what wages have grown. Savings killer number 2, healthcare. The United States spends more on healthcare per person than any other developed nation on earth, by a significant margin. And yet, Americans pay more out of pocket than citizens of any other wealthy country. More premiums, more deductibles, more co-pays, more surprise bills. Let's put numbers to this. The average employer-sponsored family health insurance premium in 2026 is around $24,000 a year. Employers cover most of that, but employees still pay an average of $6,500 a year in premiums alone. That's $541 a month coming directly out of your paycheck before you ever see it. Then add deductibles. The average deductible for employer-sponsored coverage is now over $1,500 per person, meaning the first $1,500 of medical expenses every year comes entirely out of your pocket before insurance pays a single dollar. And if you're self-employed or your employer doesn't offer coverage, you're buying on the marketplace. A family of 4 on a marketplace plan can easily pay $1,200 to $2,000 a month in premiums. That's $14,000 to $24,000 a year. A medical emergency, even with insurance, can wipe out years of savings in a single bill. 1 hospitalization, 1 surgery, 1 unexpected diagnosis. A 2023 study found that medical expenses are the leading cause of personal bankruptcy in the United States. Think about that. The number 1 reason Americans go bankrupt is not overspending on luxuries. It is getting sick. When you're spending $500 a month on premiums and living with the constant financial threat of a medical bill that could cost thousands, saving money isn't a discipline problem. It's a math problem. Savings killer number 3, transportation. Unlike most developed countries, America was built around the car. Public transit in most American cities ranges from limited to non-existent. For the vast majority of Americans, a car is not a luxury. It is a requirement for employment. The average total cost of car ownership in the U.S. in 2026, including loan payment or depreciation, insurance, gas, maintenance, registration, and parking, is approximately $12,000 per year. That's $1,000 a month. For a household earning $74,000, that's 16% of gross income going to a depreciating asset that loses value the moment you drive it off the lot. And that's for 1 car. Millions of American households have 2. Here's where it gets worse. Because American cities spread out so far, with jobs in one area, affordable housing in another, many workers have no choice but to commute long distances. The average American commute is about 27 minutes each way, but millions of workers commute 45 minutes, an hour, even 90 minutes each way just to afford rent. The irony is brutal. The more you try to save money on housing by moving further out, the more you spend on transportation getting back in. It's a trap built into the physical structure of American cities, and no amount of cutting subscriptions fixes it. Savings killers 4 and 5, and I'm putting these together because they often hit the same generation at the same time. Student debt and childcare. Student loan debt in America now totals over $1.7 trillion. The average monthly payment for a borrower in repayment is around $500. That's $500 a month. Before housing, before food, before anything. Going to a degree that was sold as the path to financial security. And for the millions of Americans paying off student loans while also raising children, childcare costs have become catastrophic. The average cost of full-time childcare in the United States is now over $15,000 per year per child. In major cities, New York, San Francisco, Washington, D.C., you're looking at $25,000 to $40,000 a year for a single child in full-time care. For many dual-income households, one parent's entire salary goes entirely to childcare. They're not working to build wealth. They're working to break even on the cost of being able to go to work. Think about what that means. A 28-year-old paying $500 a month in student loans plus $1,200 a month in childcare. That's $1,700 a month gone before rent, before food, before healthcare, before transportation. On a $74,000 salary, take-home pay is roughly $4,750 a month. After those 2 expenses alone, $3,050 remains for everything else. Tell me again about the latte. Now here's the part that makes all of this worse. The personal finance industry, the books, the podcasts, the YouTube channels, the gurus, have a vested interest in making you believe that your financial situation is entirely your fault. Because if it's your fault, you'll You'll buy the budget planner. You'll sign up for the course. You'll download the app. If it's a structural problem, if housing costs too much, if healthcare is broken, if wages haven't kept up with inflation, then there's nothing to sell you. So instead, they focus on the latte, the subscription, the dinner out, the thing you can control, the thing that makes you feel guilty and therefore motivated to buy a solution. This is not an accident. It is a business model. And here's the psychological damage it causes. When Americans believe their money problems are caused by personal failures, poor discipline, bad habits, weak character, they feel shame. Shame makes people avoid the problem. Avoid looking at their bank account. Avoid making a budget. Avoid thinking about retirement. That shame and avoidance is far more financially damaging than any latte ever could be. The first step to actually fixing your finances is understanding that the system is genuinely hard. You are not failing at an easy game. You are playing a hard game and doing reasonably well just by surviving it. That's not an excuse, it's context. And context matters when you're trying to make real decisions. So what do you actually do? If cutting small expenses doesn't move the needle, what does? The answer is simple, but not easy. You have to attack the big numbers, not the $6 ones. The $600 and $6,000 ones. Big move number 1. Housing arbitrage. If you live in a high cost of living city and your job can be done remotely, even partially, moving 30 to 60 miles out of the city center can cut your rent or mortgage payment by $800 to $1,500 a month. That's $10,000 to $18,000 a year. No budget app, no latte ban, no subscription audit will ever come close to that number. Big move number 2. Income growth over expense cutting. Cutting expenses has a floor. You can only cut so far before you're cutting into quality of life. Income has no ceiling. A $5,000 raise, a job change that increases your salary by 15%, a side income that generates $800 a month. Any of these moves does more for your savings rate than 10 years of coffee abstinence. Negotiate every raise. Job hop strategically. The research is clear. People who change jobs every 2 to 3 years earn significantly more over a career than those who stay and wait for annual increases. Big move number 3. Automate savings before you can spend it. The most effective savings strategy is not willpower, it's removal. When savings happen automatically before your paycheck hits your checking account, you never make the decision to spend it. Set up automatic transfers the same day your paycheck deposits. Even $200 a month. Even $100. The amount matters less than the habit. Pay yourself first, every time, without exception. Big move number 4. Health savings account if you're eligible. If your employer offers a high deductible health plan with an HSA, use it. An HSA is the only triple tax advantaged account in America. Contributions are pre-tax. Growth is tax-free. Withdrawals for medical expenses are tax-free. In 2026, you can contribute up to $4,150 as an individual or $8,300 as a family. Money you don't use rolls over forever. It never expires. After 65, you can use it for anything. It's one of the most powerful and underused savings tools most Americans have access to. Here's the thing I want you to take away from this video. If you've been struggling to save money, if you've tried the budgets and the spreadsheets and the no-spend months and nothing seems to work, you are not broken. You are responding rationally to an irrational system. Housing costs too much. Healthcare costs too much. Wages have not kept up. Student debt is crushing a generation. Childcare is out of reach for millions of families. These are real. They are documented. They are not in your head. But here's the other truth. Understanding the system doesn't mean surrendering to it. It means you stop wasting energy on $6 solutions to $600 problems and start making moves that actually change the math. Attack the big numbers, grow your income, automate your savings. Use every tax-advantaged account available to you. That is how you win a hard game. If this video gave you a clearer picture of what's actually happening to your money, That's exactly what this channel is here for. Subscribe and come back next week. See you then.